from now as well.
And we have
Okay, brilliant. Yeah. Excellent. Thank you. Okay, bye.
So good morning, everyone, and welcome to the Haslers Webinar Corporation Tax to increase to 25% and what you need to know. So before I make the introductions, we'll just do a little bit of housekeeping. So if you do have any questions, please feel free just to pop it in the messages and we'll take the questions at the end. So as we have a lot of attendees online today, if you could please keep yourself muted throughout, that would be great, just to make sure there's as little interference as possible. So just to let you know, we'll be recording this webinar today. So at the end, we'll send you a link to the recording. So if you did want to watch some or all of it back, then feel free to do so. So today's webinar is presented by Haslers Chairman and Senior Tax Partner, John O'Shea, and Senior Tax Partner, Paul Reynolds. I believe John will be kicking off the presentation, so I'll now pass over to John. We hope you enjoy.
Thank you, Charlotte, and good morning, everyone, and welcome to our latest webinar. It's been a couple of months now since the increase in corporation tax was announced, and like all good tax increases, they're announced well in advance these days to make it not sound so bad. I think the actual increase itself, as I'm sure you are all aware, comes in from 1st of April 23. So we're going to cover some of the issues that arise with that increase, and a couple of other connected tax increases that happen in the same period of time as well. But as with all my webinars, I always like to start a little bit with the history of corporation tax so people can understand how we arrived at the current situation. It's got quite an interesting history, really. If you go back in time, the concept of companies being registered at Companies House started way back in 1844, believe it or not. And for the first 11 years or so, there was no such thing as limited liability. You could register a company, but the shareholders were still liable pretty much in the same way as a partnership is for the debts of the company. And that changed in 1855, the Limited Liability Act, which was when limited companies could first be formed. In fact, I was looking back earlier just to see what the oldest surviving limited company is still registered at Companies House, and it's a company called the Ashford Cattle Market Company. They were registered in 1856, September 1856, and they got a company registration number of 118. If you want to go and look up a little bit of history there. I was trying to find a little bit more about the company, but unbelievably, despite being around for 165 years, haven't even got their own website yet. Anyway, initially companies, when they were first formed, were still charged to income tax, in fact. And then there were some additional rates for both retained profits and profits that were distributed to shareholders. And obviously, with all new legislation, it took time for Parliament then to draw up a specific set of rules and tax legislation for limited companies. And when I say some time, it actually took them 110 years. Because corporation tax didn't actually come into being until 1965, some 110 years after the Limited Liability Act itself. So they took a bit of time to think about the rules, I guess. And then we had a period of time between 73 and 99 where there was a sort of ancillary system called advanced corporation tax. And that was really where companies were paying out dividends to shareholders. At the same time you made that dividend payment, you had to pay some advanced corporation tax, and that was offset against your eventual corporation tax liability. And importantly, also the people that received those dividends could reclaim the tax credits that were available, and that led to a lot of repayment, especially with tax exempt schemes like pension funds, etc. That was all good until 99, and then Gordon Brown came along and he spoiled the party, so to speak. And he abolished the concept of advanced corporation tax from 99 onwards. And this led to a 20% drop in dividend income, effectively for pension funds and other tax-exempt investments. And his timing couldn't have been worse, really, because it was around the time of the dot-com crash when the FTSE fell from, I think it was 69.30 in December 99 down to just under 3,300 by March 2003, with the effect of the Iraq War at that time as well. So that's really one of the reasons why all the pension shortfalls arose over the last couple of decades, and there's still many schemes still actually recovering from that. And interestingly, actually, the FTSE today, this morning, assuming it stays relatively stable, who knows at the moment, it's only actually 500 points above that high from December 99. So we haven't made a lot of progress there, really. Looking at the rates themselves, when corporation tax was first introduced, it had a starting rate of 40%. That was back in 65. And as you'll see, over the decades, it actually went up in the 70s to a pretty eye-watering 52% before starting to gradually fall away. And in that decade of the 70s also, you would think, okay, well, I don't want to pay corporation tax at 52%. I'll just take all my money out of my private company. There were income tax rates that had a high of 83%. The highest rate of income tax was 83%. And then there was another charge of 15% called the investment income surcharge, which was payable on dividends. So you couldn't really avoid the corporation tax by taking it out as a dividend, because you basically had to give all the money back to the government. But that started to change really in the Thatcher era. From, I think it was 82 onwards, the rates started to fall in 5% chunks, and by the sort of mid 80s it had come down to 35%, which at that time was it was a historic low, still very high in today's terms. And gradually over the next few decades it's fallen to the current rate of 19%, and for the first time in some considerable time we are now looking at a pretty substantial increase from 23. But when you compare it to the history of corporation tax, you would have to say that it's still at a relatively low level. It's also interesting to know that, I don't know if it's actually in the manifesto, but it's certainly a stated Tory goal that they wanted to bring corporation tax down to 15%. It'll be interesting to see what happens about that over the next few years or so. And perhaps surprisingly, the amount of corporation tax collected by the government in 2021 is probably smaller than you think. It amounts to 54 billion out of total government receipts of 793 billion. So it's only actually contributing 7% of the UK revenue, and the increase from 19 to 25%, according to the estimates from the Treasury Department, should increase the tax take by somewhere between 12 and 14 billion, they think. We will see if that is the case. Of course, I think everyone's seen the headline rate, which is that taxes going up to 25%. It's not quite as simple as that. As we'll see on the next slide, the rates that are being introduced, there's actually 3 different rates of corporation tax. Everyone knows, I think, that the main rate is going up to 25%, but that only applies for companies in the profit band £250,000 and upwards. There is a small rate band that is coming in, which is effectively set at the current rate, 19%, and that's meant to help the small businesses. But what we end up with as a result of the difference between the 2 rates is a higher tax rate in that margin in the middle. Why is that? Because, well, it's just a maths exercise, really. If you're going from a 19% rate band at 50,000 and you've got to get that back up to a rate band of 25% by the time you hit the 250,000 mark, then you need to gradually increase the tax take in that middle band. So between 50,000 of profit and 250,000 of profit, the corporation tax rate, the real rate, if you like, is actually 26.5%. So an even more significant increase than perhaps people might have first thought. The note on the bottom there, Paul will cover this point in a lot more detail later, but associated companies, which are things I think people have forgotten about, are very relevant also now when working out these tax rates, and there'll be some examples on that later on. Moving on to some calculations then, just to see how it works. And one of the factors with an increase in corporation tax rates, a lot of people are asking us now whether or not they should still be a limited company or whether they should be self-employed. I think with rates having been relatively low for some period of time, the vast majority of people, once they get to a certain level of income, are assuming always that a limited company provides a lower tax scenario. As we can see here, it's not always quite as simple as you think. And this example is intended to show the difference between a self-employed individual and an individual might set himself up as a limited company and then withdraw all of his money via dividend during the year. There's some pretty complex tax calculations behind all of this, but in brief, if you look down the 50,000 column, the column on the left, if you earn £50,000 as a self-employed individual, after you pay your tax and national insurance, you end up with a net income just under 39,000. The effective rate of tax is about 22.5%, which doesn't sound too bad overall, albeit I haven't heard many self-employed people say that's a reasonable amount of tax to pay. If you compare that to the company situation, there the company pays corporation tax first, currently at 19%. That's your 9,500. And then if all of the balance is withdrawn by way of dividend, then you have to pay the dividend rate, which for basic rate payers is set currently at 7.5%. And you'll see that the net income comes down to broadly the same figure. The effective rate of tax is within, a couple of 0.2%. And the same example really applies on the 150,000 bracket. The effective tax rate for self-employed individuals has risen to 38.85% at that point. Bear in mind that personal allowances start to be taken away once you get over the 100,000 of personal income. And by the time you've gone through 125,000 of income, you've lost your personal allowance completely. So the effective rate for the corporate is almost identical again. Income 150,000, you pay your corporation tax again at 19%. And then dividend tax at that point has risen on the amount above the basic rate band to 32.5%, giving more or less the same effective rate. And even at the far end of the scale, someone is earning 250,000, as a self-employed individual, his effective tax rate, his overall tax rate has now risen to 42%. Compare that to a corporate situation, paying the corporation tax again at 19%, and then dividend tax, which rises over 150,000 of income to 38.1%. You see once again that the figures come out broadly the same. Why is that? Well, it's not an accident. It's actually by design, and the increase in the dividend rates, because they were originally 0 and 25%, came in 16-17, and it was actually designed to close the gap, if you like, between corporate and self-employed individuals and those who are incorporating purely for tax purposes. So these examples obviously show, if you like, the worst situation. This is a situation if you don't do any planning and leave matters just to be taken out. But move forward to 23-24. Now I've skipped 22-23 because 23-24 is the first full year that we have the corporation tax increase, and you'll see that the figures at the top of the slide are broadly the same, but the only difference in these self-employed tax and national insurance figures is the additional 1.25% that is coming in actually from April this year. As national insurance this year, it's actually called the Health and Social Care Levy. So that increases the effective rate of tax for the self-employed individuals by roughly 1.25%. But when we look down to the company scenario, and we start to get some variation in the effective rate of tax. And that's taking into account the increase in corporation tax. So in the 50,000 example, it's broadly the same again, almost identical in fact. On this example, the dividend tax rate now has gone up to 8.75 to take into account the 1.25% increase. Corporation tax at that point still at 19%. The middle column, the 150,000 column, you start to see the effect of the additional corporation tax. Now, the first 50,000 of profit in that column has been taxed at 19%. And then after that, you've got 26.5% corporation tax being paid on the next 100,000 of profit. The dividend tax has gone up again from the 32.5 to 33.75 now, with the new levy that is coming in. And you'll see for the first time that there's a differential in the effective rates of tax, and actually the corporate tax position gives a worse tax position than a self-employed individual, which is probably not what most people would think. When we get to the 250,000 example, the position's got even worse. 250,000, the income tax position, broadly the same again. You've got the extra 1.25% that's in there. And from a corporate point of view, the dividend tax rate has now gone up at the top end to 39.35%, taking into account the extra 1.25%. And that gives a whopping effective tax rate of 47% for the corporate compared to the self-employed individual. The figures are actually more extreme than that, because whilst these give you the figures overall for those particular bands, it's important to look at the tax rates on the margins of these bands. So on the next slide, I'll sort of try and demonstrate what we need to be thinking about now. This is more complicated to follow, so I'll spend a bit of time here. What I'm trying to show you here is the difference in tax rates on, if you like, the top £10,000 in each of those previous bands, and whether or not it's better to take it as a dividend or whether it's better to take it as a bonus. That used to be one of the things we looked at all the time. Depending on whether you're in the marginal rate of tax, sometimes it was better to take a dividend out to extract your income. Sometimes it was better to take a bonus or salary. And you'll see in the 50,000 example, that sort of top slice, there is a dramatic difference in the effective rate of tax. And that is largely because of the employer's national insurance, which is kicked in for the first time, and also the first slug of national insurance for the individuals. To put in perspective, the employer's national insurance currently 13.8%. That goes up to 15.05% from next year. And the rates for employed individuals, you pay 12% national insurance up to roughly the higher rate band, and then an additional rate of 2%, and they're going up to 13.25 and 3.25%. So that impact to the additional national insurance absolutely kills the position in that sort of lower band, the 50,000 band. So you have to be very careful that you're taking your income out in the most effective way. The position, once you get to the higher figures, there isn't so much difference between whether you take it as bonus or dividend, but I think both examples demonstrate what the real rate of tax actually is. You look at the example, the top £10,000 of income for someone who's in the marginal rate of corporation tax, and they're a 40% taxpayer, the effective rate of tax is effectively over 50%. Either way, it's over 50%. Whether you take it as a dividend or whether you take it as a bonus, you're over 50% tax at that point. Once you go beyond that, so let's say you've got to the full corporation tax, you're making 250,000 profit each year, your personal income is over the 150,000 mark. At the margins, that last 10,000 of income is going to cost you 55%. Well over the top rate of 45%. Of course, that's the one everyone remembers. and it's that combined effect of the corporation tax and also the additional income tax and the increase in the one, and all combines to actually create a true extraction rate, if you like, from limited companies of 55%. Now, of course, these examples are here to be extreme and to demonstrate the point. What I think it points out is a lot of work needs to be done between now and 1st of April 23, looking at how people are extracting money from their companies, whether or not they are making best use of the many different tax reliefs and allowances that are out there, whether they're making best use of planning with spouses and other family members and possibly trusts as well. When you tell people that the top rate of tax is 55%, tends to get their attention. So it's something that needs some thought. And the days, if you like, of drawing up a set of accounts and then deciding that, you know, a dividend was paid on the last day of the year, that doesn't really work because you don't have the time to make the changes. Now we've got to get ahead of the curve. And if you don't plan in advance, these are the rates that you're going to be facing, unfortunately. So whilst corporation tax on its own increasing from 19 to 25 is not exactly welcome, it's the combined effect on extracting the money where the pain really starts to kick in. So what can we do about that? Well, Paul's going to tell you about possible disincorporation, and also just come back to this point on associated companies, because there's legislation there that many people will have forgotten about that's very relevant, and I'm sure he's got some interesting facts on that. So I'll hand you over to Paul at this point, and I'll come back on at the end when we get to the questions.
Right, thanks, John. Thanks for that. So, yeah, essentially now, firstly, I'm going to talk about disincorporation, which in its most basic form is the opposite of incorporation, whereby individuals take their business into the company in exchange for shares. Here, because of these tax rates changes, we're looking at actually, can we take our business assets out of the company, back out of the company by way of disincorporation, back into the shareholders' hands. So we'll move away from the company, the business becomes, the trade becomes unlimited, and we can just carry on in that format, paying tax on a self-employed basis, as John showed in his slides earlier. Now, the good news is that in terms of disincorporation, which is quite different to incorporation, we don't need to get Revenue Customs advance clearance. We don't, in fact, need to notify them that we're intending to do this, or in fact, it has taken place. So we've got a degree of flexibility for this planning. Could you put on the next slide, please, Charlotte? So for those who are considering disincorporation, what are the things and factors that they need to think about? Well, the first thing, which is quite strange, is that there is no formal tax relief for disincorporation. So again, if you compare it to incorporation, where there is a formal tax relief that can be claimed, there's no equivalent currently for disincorporation. There used to be a few years ago, but hardly anybody used it, probably because there was low corporation tax rates at that time. So whether it comes back, who knows? But currently, there is no tax relief for disincorporation. So we then need to think about different elements of the disincorporation process, some which can be tax-free, some which will be chargeable. So starting with the most pain-free items, any stock that is held or any items that are qualified and claimed capital allowances within corporation tax, those assets can be passed out freely to the owner managers on a tax-free basis with a simple election confirming that no tax is to be paid either by the company or by the individual on receiving those items. So if we have a company that just contains stock and capital allowances, disincorporation is going to be a relatively straightforward process in terms of chargeable items. Where we will face with some difficulties are existing companies that hold properties or have a value, intangible value within their existing business. Because for both property and goodwill, there isn't a relief to override any tax charges So as far as the company is concerned, there'll be a tax charge within the company at a market value disposal of both the business at its current market value as well as the property. So when we're factoring in and deciding on whether it's appropriate to disincorporate, then there is going to be, for those companies, an element of tax that will be payable that cannot be completely mitigated, and that needs to form part of your calculations as to whether it is a good thing or otherwise to disincorporate. And in terms of other points that we need to think about, well, VAT is potentially an issue. Again, that should be relatively straightforward because we should be able to rely upon transfer of going concern provisions. So that is, we can just transfer the business VAT-free from the company to the business owners, but that will require a certain degree of work to ensure that those conditions are met. If we're looking at property, again, property leaving the company, yes, there may be a corporation tax charge, but there is also potential for a stamp duty land tax charge as well. And the likelihood is by way of extracting the business by disincorporating the business and assets to the shareholders, it is likely that would have to be done by way of a member's voluntary liquidation, an MVL, and that in itself will incur a cost, but also will have a capital gains tax implication. So for those who are seeing the slides showing the relatively low tax numbers for self-employed, then that is something they should consider, but they need to factor in the fact that there may be costs associated with disincorporation, particularly if we've got high value property that been bought for a number of years ago, or already we've got a valuable business name that is sitting within the company that we wish to get out. Next slide, please, Charlotte. So and then my final slide, talking about associated companies that John touched on previously. And that phrase there back is a little bit of a false statement in so much as they have been with us for the last 10 years. It's just what was considered an associated company was very restricted. So currently, in terms of whether something is associated and impacts on our corporation tax bands, it is only those companies that are in a part of the same group. So if you had two companies within a group, you've got two associated companies, and therefore you would manage your bands accordingly. If, however, you owned two companies independently, entirely 100%, they have been for the last 10 years not considered associated. But unfortunately, the old rules, sort of pre-2011 rules, are now back, and we are now faced with including those as associated. So in terms of for smaller companies, where that will have an impact is where it will just reduce the available bands that are 50% and the 200,000 band, so that we'll be paying much more corporation tax in that particular scenario. When we start having larger profits and larger number of associates, then we need to think about the large payment regime and the very large payment regime. So as there on the slide, a large company will pay corporation tax at 1.5 million, but that 1.5 million band is reduced, spread over the number of associated companies. So if I have 10 associated companies, well, including my own of 10 associated companies, I will then be considered large if I have profits over 150,000. And if my profits are over 150,000, I fall within large regime, which means I have to make quarterly payments in advance of all other corporation tax payments. And then same regime would apply, but to the very large, the threshold becomes 20 million. And therefore, we pay quarterly payments just that slightly earlier. So it's going to have an impact for most companies when assessing the number of 50,000 bands we have available or 200,000 bands we have available. But equally, it could drag others into paying corporation tax far earlier than would otherwise be the case, particularly, I think, obviously, on the 1.5 million. If we have, let's say, even 4 associated together ourselves, we're then looking at profits of 300,000. Just one exceeding that figure will then result in quarterly payments. Now, for those who've been working in tax for a few years, that is all familiar to what the old rules would have been. But now we need to start thinking about, okay, well, where do the profits sit? Should we have all those companies? What is the value of holding those companies? Could some of those companies be amalgamated? Do we need to raise management charges from one company to another? So we spread the profits to get them at the right level. That's without thinking about the VAT issues that result from that. So what is not included as an associated company, is it said on their slide, is so non-trading companies, but that is very, very limited. So if we had a company that had bank charges going through its bank account or one rent payment on a quarterly basis, that wouldn't be considered non-trading. So it's really, a company has no entries whatsoever on in its bank account, on its journals, then it would be considered non-trading. Otherwise, it will be considered active and trading for this purpose and will therefore be effectively a waste. So if we've got any of those smaller companies that are currently doing very little, that are held outside a group, we need to think about, actually, do we bring them in to other larger companies so therefore we manage and keep as many bands available without reducing the threshold. And then in addition to that, holding companies, again, this is for those who are familiar with the old rules, this is, again, just to reiterate, is a basis of the old rules. So if it is a pure holding company just receiving dividends from its subsidiary, then it will not be considered. But let's say it holds the property that the group trades from, that it raises rental charges for, or we have key directors sitting at management level within the holding company that we raise a management charge. Again, they will now be considered active. Again, they will be reducing our thresholds. So we've just got to take a much more involved view of what is an associated company, and do we need these companies, particularly when we could bring forward tax payments or increase tax payments. And then finally, in terms of the tests, two quirks really of the legislation concerning sort of loans and spouses. So in terms of whether a company is controlled with another, we don't look just solely at 50% plus shareholding, but also whether they can be controlled by loans as well. So an added complication, an added reason for us to assess not only our shareholding structure, but our loan structure to make sure, again, that we're not wasting a company. And then finally, spouses and other associates can sometimes be considered to be associated. And there is a test there of whether there is commercial interdependence. So again, under the old rules, before this was blocked, a standard planning technique would be instead of just one company, have two companies, one controlled by one spouse, one controlled by the other spouse. And therefore, we're now, instead of just looking at 50,000, we're looking at 100,000 of profits before we pay the higher corporation tax rates spread between the two. If there is that commercial interdependence, a reliance upon each other, they will be considered to be associated. So we'll just be rehearsing the same arguments we had from 10 years ago with Revenue Customs for those type of arrangements. So it's just important to review all of our active companies, review their shareholding structure, review the loans that are in place well in advance of April 23, just to make sure that we're not wasting any of our bands.
I think you're on mute, John.
How's that? That's better. As I was saying, the increase from 19 to 25% is just one small factor really in what needs to be looked at now. I think is the time to review, certainly for some people, whether they should still be corporate or not, even though there's some difficulties going backwards from corporate to a self-employed position. Everyone definitely needs to be looking at the way they extract income from their private companies. If they got that balance right, if they got the salary level right, have they got the dividend level right, have they got it right between family members? Are there other factors like trusts or whatever that need to be considered? All of that needs to be looked at. And then you've got the structure of the corporate world itself. You know, if you've got 5 or 6 different companies, as lots of people seem to, there seem to be a lot of new companies have been formed over the last couple of years because of bounce back loans and the like. So you're going to find that people have got more companies than perhaps they remember. That has a real impact now on not only your corporation tax, but also effectively your personal tax as well. So there's a lot to look at, but fortunately we have a bit of time. That's why we're doing this seminar very, very early. The rate increase comes in April 23, albeit the health and social care levy comes in from next April. So it's time to start looking at these situations. So at that point, normally we hand over for questions, and we're here as long as is needed. We've had good questions on previous seminars. It's actually lasted longer than the seminar itself, I think. So feel free to ask whatever you like.
John, we've had a question on the messages from Ian S. Sorry guys, would you mind very quickly explaining again the reason for the 26.5% 50k to 250k band, the explanation for the effective 26.5%?
Sure. So the way that works is the main rate band. So if you're at 250,000 of profit, you're at 25% corporation tax. So at 250,000, you pay £62,500. Okay, and anything above that still goes at 25%. If you're at the other end, the first 50,000 of profit, you're paying 19% on. So that first 50,000 of profit comes to 9,500 of corporation tax. Take one away from the other, and you're left with a difference of 53,000. And that 53,000, when applied to that band of 200,000, gives you the effective rate of 26.5%. So what happens in reality is everyone pays 19% for the first 50,000, and then for each pound above that, you pay 26.5p until you get to 250,000, in which it reverts back effectively to 25% at that point. So it's this sort of catching up scenario where you have to get from the 19 to the 25% band. The only way you can catch up to get back to that same overall rate is to have a higher rate in the middle. And that's never, ever, surprisingly, advertised when they announce these things. Does that make sense?
Does anyone else have any more questions? So Ian's just said thank you. So we've got another question from Penny. There is currently a super deduction in place. Should companies consider being careful claiming this additional relief on short-term assets? Thinking behind the question is when you sell the asset, you would effectively pay tax at a higher rate once the 25% band kicks in.
Yeah, it's almost giving the answer there as well, I think. Yeah, like, generally speaking, the advice always is claim every possible relief as soon as you can, and because that's good for your cash flow. And the super deduction effectively gives you a rate of 24.7% tax relief compared to the 19% main rate by increasing your expenditure by 30%, etc. So if you buy something for £100,000, you get relief for 130,000. So that's an extra relief, if you like, of 30,000. So you get that up front, but then when you come to sell the asset, if you've made a profit and that falls into the period of time after the rate increase, then you're going to be paying 25% on that. Can we improve on that position? I'm not quite sure that we can. I still would recommend you claim it up front, because if we don't claim it up front, then we have reduced release effectively. We don't get quite back to the same tax position if we defer that, because the AIA effectively only applies in the year in which you acquire that asset. Then you're into sort of writing down allowances. So it's always worth looking at the numbers, but generally speaking, it is still better to claim first, even if there's going to be a higher tax rate on any balancing allowance.
So we also have a question from Laura. So is the CT tapered, or if your profits are over 250k, you pay the straight 25% CT rate?
Can you say that again, Charlotte?
So is the CT tapered, or if your profits are over 250k, you pay the straight 25% CT rate?
Yeah, so I think the answer to both of those is yes, but yes, once you've reached the 250,000, if you've got a single company with profits over 250,000, it is going to be paying 25% on all of the figures. If you actually went back and did the calculation at the first 50 at 19%, and then the next 200 at 26.5%, and then the rest at 25%, it will come back to the same answer, which is an overall rate of 25%. So once you're above that 250,000, all of the profits, there's no lower rate that you get the benefit of like you do in income tax rates. The whole profit is taxed at 25%.
We have another question from Daniel. Please, could you clarify the starting date if your financial year goes to 31st of March? Thanks.
So the corporation tax rates always follow the financial year, so they always start on the 1st of April. So the new rate for corporations tax starts on the 1st of April 23. So the first full year in which that will apply is the year to 31st March 24. And the super deduction is currently scheduled to end on the 31st of March 23, just before the corporation tax increase kicks in. So the idea of getting super deduction on the 25% currently is not possible, although I've certainly seen a couple of comments from MPs saying that really should be extended, but we'll see on that.
So before we finish, has anyone else got any more questions they would like to ask? Oh, hang on. So Nathan, have there been any changes to the proportion of debt you can have against profits in a UK company now?
I'm sure I quite understand that question. Can we just ask that again?
Have there been any changes to the proportion of debt you can have against profits in a UK company now?
Perhaps the question can come on and just explain that a bit more. I wonder if that's related to property income.
He's put accountants know this as the thin cap rules.
Oh, okay. Right. I'm not aware of any changes. I must admit I haven't gone and looked at that. I don't think there's any change as a result, but I'll be honest and say I haven't actually looked at that aspect.
Okay. Any more questions before we finish? Let me just double check this. No, I mean, so obviously we have recorded this, so after we will send you an email with a link to the video so people can re-watch it. We're also offering a free one-to-one consultation as well, so if you do have any further questions, then feel free to send them over individually. So yeah, thank you very much everyone for attending today. Our next webinar is in May, on the 18th of May. It's a little bit different to corporation tax. It's an introduction to the marketing mix. So I like to call it the fun side. I'll be hosting that one. So yeah, if you'd like to attend, please drop us a message and we'll add you to the attendee list. Other than that, thank you very much, and we hope you all have a lovely day. Thank you.
Thank you, John. Thank you.
Thank you. You're welcome.
Thank you.
Thanks.